Okay, good afternoon, everyone. Thanks for joining today's webinar from Seesaw Asset Management. Today, we are very happy to invite Seesaw Asset Management to give us an update on the second half market outlook in 2024, particularly the topics on opportunities in divergency. Today, we're also very happy to invite Mr. Bruce Zhang, who is the head of fixed income team from Seesaw Asset Management, to give us this webinar. A bit of background about Mr. Bruce. Mr. Bruce is the head of fixed income team at Seesaw Asset Management and is also responsible for the portfolio management of bonds, REITs, and money market investment strategies. Before working in Seesaw, he was working at State Street Global Advisors, and he held several roles, including that of portfolio specialist and portfolio manager. I shall hand over to Mr. Bruce Zhang.
Thank you. Thanks for Philip's invitation for this session, and also thanks everyone to attend this session during the lunch time. So today we'd like to share the CSOP second half outlook, the opportunities in divergency. So today our presentation will divide into three parts. First, we'll discuss what kind of opportunities that investors could capture on the back of a divergent environment in the second half or rest of the year, and followed by the S-REITs outlook as the sector is approaching an inflection point. And at last, we will discuss how investors could access S-REITs through the CSOP Edge S-REITs Leaders Index ETF. So first of all, unlike the first half this year, when investors can still benefit from pursuing the momentum of the Japan or US stocks, such as the Max 7 stocks, as the Fed is expected to cut rates from September on the back of a bit slower inflation or a bit cooler job market, investors may seek for opportunities and a more divergent environment going forward. So it's quite clear or widely expected that the US is ready for the first rate cut in September, and some started to expect 4 or more cuts in the next 12 months. We think it is possible, but if the Fed is going to cut 100 bips by the end of this year, it is a bit over, as it may imply a recession scenario in the US. But the fact is that the recent cooling job market is partially driven by the rising number of people who are actively looking for jobs, and partially driven by the natural disasters in the US. And similarly, the US inflation is cooling from its peak, but the core inflation, particularly the core service inflation, is still relatively sticky, indicating the demand is still resilient, or at least not a recession scenario within the US. And the start of the easing cycle, anyway, they have some implications. A typical story in the history is the Fed cuts released more liquidity for investors to seek for the higher return, such as flowing out from the US dollar assets and flow into the emerging market assets. It could be the case this round, but history may not always repeat itself. And this is because the AI and Japanese equity remains the investment themes, still with the largest growth potential, so can continue to attract more fund flows until the growth rationale are falsified. So this time, the additional liquidity may stay in the US tech leaders or Japanese equities, or at least part of the flows, as well as the APAC semiconductor leaders. The AI story is quite clear. I know a lot of people are still waiting for this NVIDIA's the announcements, but particularly for those hardware investment, their keeps are growing thanks to the barriers to profitability. And in the long term, the AI adoption will finally benefit the devices and software, in addition to the infrastructure, like the semiconductors and also the cloud. But short-term volatility is also worth paying attention to due to the high concentration of the US stock market. And in addition to the US, the Taiwan and also South Korea main beneficiaries from the growing demand for the semiconductors and also the AI technologies. That explains the highly positive correlations between the tech names in the two markets and also the US tech stocks, as well as the strong ETF inflows year to date into these two markets. And within the emerging equity markets, the Southeast Asia has been the major beneficiary of the supply chain relocation. And part of the reason is to avoid the trade barriers, and part of the reason is to make use of the cheaper inputs from China, which is echoed by the more entry port trade or re-exports, in other words. And in contrast to the major developed economies, Japan is obviously on a firmer footing to reach its 2% inflation goal and cautiously quitting the ultra loose monetary policy for now, such as the rate hike and also the gradual reduction for the JGB purchase. And these created some volatility, but was also justified by the highest pay rise since 1990. And in the meantime, the Bank of Japan will also keep an eye on the market stability, thus reducing the chance of a near-term hike in rates. Another positive development in Japan is Japan's improved margins and also the PB ratio on the back of mild inflation and the ongoing reforms, such as the disclosure to take actions to manage cost of capital and also the enhanced stock price. And the previous long-lasted low interest rate had some side effects, such as carry trade to invest in the higher yielding underlying assets funded by the Japanese yen. But the recent upside risk of yen with expectation of the Fed's potential cut, they did trigger some widespread liquidation and also raise the near-term volatility. While this is not due to the worsened macro fundamentals, it did hit the global assets in the short term. And another interesting phenomenon is a virtual asset, such as the spot-based Bitcoin or Ether ETFs. But the volatility could be very, very high as those coins themselves do not have intrinsic underlying value. So investor sentiment, together with the supply-demand dynamics, can be very, very sensitive to news and also the rumors. And while the volatility is two-way, could be gain or loss in the future, the potential drawdown risk can't be ignored. And also look beyond the traditional hot topics. It is interesting to note that the Saudi Arabia equities could act as a good diversifier. The first impression is that the Saudi Arabia, they used to rely heavily on oil prices, and their stock market is highly correlated with the oil price movements. But in recent years, the non-oil GDP has been growing steadily, even outpacing the oil contribution to the GDP growth speed. So the market can be treated as a defensive market in the emerging market universe, backed by the oil production and also the stable dividend yield provided by sectors even beyond the energy industry, such as the banks. And in addition to the upside, in terms of the risk, first of all, we think the twists and turns under the US election process is adding some further uncertainty. And more specifically, if the Trump is elected, the more trade protectionism with a tariff hike is expected, but this time may not specific to China. It can be beyond China to other countries. And also corporate income tax cuts are anticipated as well, implying a even larger fiscal deficit in the US. So in order to mitigate this, he may even push the interest rate drop in a harder way, but of course after if he can be elected, and this may boost the popularity of some small cap investment strategy and also the S-REITs, which are very sensitive of these interest rates. And as for Japan, it seems regardless of the strength or recovery of the Japan's economy, the Bank of Japan's potential move together with the yen movement will continue to create some market volatility. And as I mentioned in the previous slides, the carry trade will be impacted anyway. And additionally, majority of the Japan's largest firms, they have the uh, global client base and global exposures. So even the yen appreciation will not totally break the story. It does impact their overseas revenue and exports and create some volatilities in the short term. And looking back the first half this year, as we can see from the left-hand side, the virtuous assets are leading the way, but also with a very high volatility. And this is followed by the Japan, US, as well as some APAC stock markets, driven by the reasons aforementioned, such as the AI boom. And China, Hong Kong stocks lagged a bit on the back of the modest growth with a slow policy implementation. And S-REITs, also together with the US Treasury bonds, were laggards in the first half on the back of the high for long environment, but are expected to rebound ahead of or during the Fed cut cycle. And also, we have also already seen this initial rebound in July and in August. And on a forward-looking basis, from an asset allocation perspective, starting from the FX, the US dollar or DXY may start to weaken on the back of cut, but a sharp drop is also less likely as the relative the fundamental strength with the positive carry may still help support the greenback if we take all other factors equal. And as for fixed income, we are continue to constructive on U.S. Treasuries. Despite some supply noises, the current high interest rate with the upcoming rate cuts will benefit the whole sectors, particularly the long-term sector. Since I already touched a bit on stock in the previous section, so I'll be briefly talk about the stock outlook. So in short, the earnings will support the US and Japanese equities as compared to the multiple expansion in the past few quarters. And APAC and Southeast Asia stocks, together with Indian equities, can continue to benefit from the AI boom and also the supply chain relocation. And China stocks are more policy driven at the current stage, both onshore and offshore. And as for alternative assets, particularly for the S-REITs, they could benefit from their current attractive evaluation and also the Fed cuts, as well as the solid dividends, which is more than 6%. But for crypto assets, their volatility is expected to stay high. And in the second section, we'll specifically discuss the S-REITs outlook because the sector is approaching an inflection point ahead of the Fed cut. So in this page, while S-REITs have been affected by the high interest rates, this also reflected in the DPU force in the short term, their fundamentals stay strong. And if you look at the table on the right-hand side, by sectors, the Grade B office is still under pressure, but Grade A office is quite well positioned due to their locations and also their quality. And as for retail, both suburban and central malls are doing well thanks to the resilient local consumption and also the tourist spending. And this also together with a tight supply. And industrial rates are divergent as business parks continue to suffer from the vacancy risk, while logistic rates are relatively stable. And finally, for hotel rates, they may have peaked, unfortunately, with a new supply and budget-worried travelers. So to improve the occupancy is the key instead of the room rate or the room price. So overall speaking, the rental reversions for S-REITs are expected to be in the high single digits this year. It's not bad. And particularly for S-REITs, the retail REITs, they may even achieve a double-digit reversions thanks to the strong central and suburban mall support after renewing their previous low pandemic leases. And relatively speaking, office industrial are mixed, but there are also some highlights such as Grade A office and also the logistic rates. But for hotel RevPAR, they have already moderated from this previous peak. And more importantly, as the Fed is expected to start its rate cut cycle, maybe in a couple of weeks' time, now it is an optimal time for S rates as the fall in base rates is anticipated to alleviate pressures on S rates. And according to the broker research, if the 3 months the swap rate falls by around 1%, then S-REIT's average financing cost could fall by 30 bips, which could support the S-REIT price higher in the near term. And in terms of these underlying S-REITs, and this time quite different because in the past we're talking about S-REITs with a strong fundamental, with the more prudent balance sheets, they benefit more from the previous environment. But this time, those S-REITs with a low debt hedge ratios would benefit more from the lower rates. So if the interest rates start to decline, they should see even the most DPU gains this round. And additionally, the FX risk have been easing because the past previous SGD or Sing dollar strands used to hurt those S rates with large international exposures. But once these are start to reverse, the headwind will turn into tailwinds. And also, even if the FX is not going to reverse soon, most S-REITs managers they already have a long-term FX hedges in place, and specifically as for the S-REITs with a large GPU exposure, hedging is also in place. And since the Japanese yen start to see recovery in recent 2 months, though this will also benefit their unhedged part of their Japanese yen exposure. So FX is no longer a headwind for those S-REITs. So on a forward-looking basis, despite the recent rebound in price, the S-REITs are still roughly 12% cheaper than levels in early 2022. So still have a great potential, particularly given that all the major sectors, office, retail, industrial REITs, are expected to deliver earnings surprises due to the resilient income generation capability. And in the third session, we will discuss why investors should use the ETF vehicle to access the S-REITs as compared to direct investment in the underlying S-REITs. In short, the ETF could provide diversification with the stable yield as well as the potential lower cost due to the underlying liquidity access. And in some cases, ETF could even outperform the benchmark, offsetting the part or even all the management fees and benefits the end investors. I'll mention this in the later stage. So in addition to the tactical opportunities aforementioned, the S-REITs in aggregate may also have some strategic case because it has a higher yield than Singapore stocks, Singapore Treasury bonds, and also the SGD deposits, as well as the MS core inflation. For example, recently the Sing dollar deposit already getting lower and lower. Let's say maybe even cannot reach 3%, but the S-REITs they can still keep a roughly a 6% yield. So it's quite very, very strong. And in the meantime, as shown on the right-hand side, their high dividend yield is not at the cost of high volatility because its volatility is still relatively low. So these translate into a very attractive return risk profile. And look forward into the next 2 years, while inflation started to slow from its peak, the S-REITs yield may continue to see higher dividend yield as leading S-REIT names. They could transit their cost pressure to end customers because there are pricing power and continue to improve its DPU. And even inflation is more sticky than expected because the rent is also part of this CPI or the part of the inflation, which means the leading S-REIT names can still leverage of this sticky inflation to improve their overall dividend yield, dividend payment. And these also explain why the S-REIT is one of the best performing REITs. markets in the past 7 to 8 years as compared to global, US, and APAC REITs. Price and FX could impact short-term performance a lot. For example, the upcoming REIT cycle is more impact these potential price rebound. The long-term stable return is supported by the solid dividend yield within S-REITs. So why S-REITs could outperform by others? I think another reason is that S-REITs at the underlying is highly diversified. We don't only have the office or only have the retail REITs. We also have some industrial data center and defensive REITs such as healthcare. But as compared to the global REITs such as the US REITs, which still have a large exposure to office REITs and still are suffering or impacted by this work from home arrangement. So these S-REITs is more resilient on a forward-looking basis. And this page is actually list the SGX, the IH S-REIT leaders index that our ETF is tracking. So I would not read the numbers one by one, but briefly speaking, the index tends to include the largest and the most liquid S-REITs. And this method means our ETF could take advantage of the potential rebound in the upcoming REIT cut cycle because it represents the most liquid part of the investment universe. So our beta will accurately capture these potential rebound. And also, if you look at the chart top right, the sector allocation is a result of the market cap and liquidity screening instead of the reason, which means we will always capture the winners, overweight winners, and underweight the losers over the period of time. And the underlying country market allocation means individual investors, they could have APAC or even global risk exposure solely investing in S-REITs because the S-REITs their business can be beyond Singapore. But for individual investors, they can continue to enjoy a zero withholding tax benefits because all the S-REITs are listed on SGX. And the large and mid-cap S-REIT holdings in our index portfolio, they have the scale advantage. And in simple words, if you look at the table on the left, the large market cap may imply more liquidity with a higher valuation, and these in turn help them raise more equity and acquire properties and also conduct some asset enhancement initiatives, AEI. And this is also echoed by our performance in the history when the larger peers is better than the smaller peers. And given that the gearing is still reasonable at 37%, way below the 50% new threshold, so there's still a lot of room for them to expand their business. And additionally, most large and mid-cap S-REITs, or roughly 70% in our portfolio, is sponsored by the GLC or the government-linked entities. And this would help them acquire quality, newer, well-located, and also the dominant assets, or even achieve the global outreach through their strong sponsor pipeline from their government sponsors. So these would translate into a yield spread advantage if adding their funding channel advantages. And more encouragingly, I think everybody already knows, as the leverage limit is raised to 50% with the ICR requirement lowered to 1.5 multiple by MAS, there is more potential for higher debt headroom to expand their business, particularly if the interest rates are also more friendly to S-REITs. And ETF itself also has a liquidity advantage as well, thanks to the dedicated trading team hired by the ETF managers with the managers' trading network and also the trading scale. And these are lower trading cost of the underlying S-REITs is translated into the tight beta spread of this ETF vehicle. So taking our CSOP's SRT as an example, its bid-ask spread is lower than almost all its underlying S-REITs, and their bid-ask spread just 2 or 3 ticks. And for now, it's just less than half of the underlying S-REITs if investors directly buy the same S-REITs basket by themselves. And diversification benefits can't be ignored, as SRT index had almost the lowest volatility versus its underlying holdings. And these implies a lower drawdown in the history, only just around -20%. And also to echo my previous point, well, S-REITs, in recent months, they rebounded a bit. It is far from its previous peak, so still have great potential. So investors here may ask that why don't we directly buy the single S-REITs if we have a high conviction? I think it's nothing wrong. As long as investors have a high conviction, they can definitely buy the single REITs by themselves. But investors should be pay attention to these high concentration risks, the drawdown risk, and also the potential high trading costs as compared to owning a ETF vehicle. So as compared to directly owning the property or the physical property or the single S-REIT, the S-REIT ETF vehicle has a more diversified underlying with a potential lower cost and a very, very low entry threshold. And because if you own a investment universe by yourself, you may need to maybe 2,000 or even 3,000, 4,000, depending on the price of these to own a very, very small basket. But when you use an ETF vehicle, then your starting lot size is just less than $1. And the liquidity and transparency are also very high because ETF, they have intraday prices available and also has a daily holdings available to public investors. So we don't hide this because our advantage is more is leverage based on our scale instead of how whether we hide or not hide our underlying holdings. And the dividend is also stable because it's a weighted average dividend instead of the volatile range of these single REITs dividend yield. And currently still quite decent with more than 6%. And all individual investors, I want to highlight this again, whether they are Singaporean or foreigners, and whether they are living in Singapore or they're living in other countries, they are free of withholding tax when investing the S-REIT ETF. And this page, it's a snapshot of our CSOP iEdge S-REIT Leaders Index ETF. The ticker is SRT on SGX for a Sing dollar counter and SRU for US dollar counter. As I mentioned, lot size just one on single exchange, and dividend distribution is semi-annually. And while the half-year dividend is just paid in late August 22, if my memory is correct, investors can still benefit from the capital gain potential in the upcoming rate cut cycle, maybe in a few weeks' time. And management fee is 50 bp, with the total expense ratio is capped at the 60 bps, regardless of the ETF size. So this is the largest possible management cost or the expense ratio that the investor can imagine. And from performance-wise, the July and August month-to-date return, they already turned positive. But given that the long-term return are still negative, there's still a great potential for further rebound of the SRT return. So if, for example, if the market start to correct it a bit because of these different opinion about the frequency and the magnitude of the upcoming rate cut cycle, then I think it's a good time to investors to re-enter these sectors to capture even larger capital gain potential for the SRT. And more interestingly, if you look at the excess return, the SRT is actually outperforming the benchmark since inception. In fact, offsetting all the 60 bips TERs, thanks to the tax efficiency and also the corporate active participation into the corporate actions. So from this perspective, investors should be not too worried about the management fee or TER they paid, because the historical track record, almost 3 years track record, already proves that we could help investors to save to save your trading the cost, the management fee cost, through our trading, through our corporate actions participation, and also through our tax saving. So in summary, the SRT could help investors access the large and mid-cap S-REITs in a diversified and also in a cost-efficient way. And in addition to the decent yield, dividend yield payment, historically our payment is more than 6% annualized. Investors could also benefit from the capital gain potential from the large and liquid beta names that our ETF holds for now. So I'll stop here and welcome any questions about the market, about the S-REITs outlook, as also as our S-REITs ETF. Thanks.
All right, thanks, Bruce. So for the audiences, if you have any questions, just fill in to leave your questions in the Q&A section. We will be open to take on some questions that you may have.
Yeah, I saw one question in the Zoom. The price is based on NAV or supply demand. I think you raise a very good question, because for individual investors, when you see these price on the, let's say, on the website or on Bloomberg or on the platform like the Philip platform, then these will be what you see is the price return, which means if we decompose this return, it's just like you asked, it's based on the intraday NAV, but also impacted by the supply and demand. For example, if let's say if today's this price let's say is 0.8, then if the NAV is 0.8, and then the intraday price will impact by the supply and demand. For example, if there is a overbought, let's say demand more than supply, then the quoted price can be higher than the NAV, maybe let's say 0.81 or even higher. And if there is a supply, let's say supply larger than the demand, then there may be a price discount versus the NAV. Let's say that it can be a 0.79 or even 0.78. So price it still starts from the NAV, but supply demand could impact your price on a daily basis, particularly for the intraday prices. And second question, how to compare against the Lion Philip S-REITs? Again, even they are our major peer on SGX. I won't say this is a black or white comparison, because our peer ETF, they are more start from a let's say the smart beta approach, which is not very straightforward, not because the underlying methodology is not disclosed to the end investors. But roughly speaking, if you look at the historical performance pattern, the smart beta based or sector or factor based strategy, they tends to perform well when markets went down. But for our index method or for our ETF method, since we tend to capture the most liquid large and mid cap S-REITs, we tend to perform well when markets start to rebound, because our method is quite straightforward. We just weight our S-REITs based on the market cap and the liquidity. So all else equal, the larger the weight and the more liquid of the S-REITs, they will have a larger weighting in our portfolio. So indeed, that's why I want to highlight is that ahead of the Fed cut cycle, this is quite important for investors to use a liquid and large cap focused S-REIT universe to capture the beta rally, the broad based rally for S-REITs. So that's why we think we'd rather supplement each other as compared to our peers. They tend to perform well when markets during the market downturn. We tend to perform well when markets is expected to rebound very dramatically.
If you have any other questions, just feel free to just type inside the Q&A segment.
Don't be shy. Feel free to ask because we over the past 2 years we have been witnessing a most aggressive Fed hikes over the past 40 years. But now we are ahead of the maybe another start of the rate cut cycle. So it's a quite this is a quite rare opportunity to capture this rate cut cycle of the to harvest some capital gain from the S rates, because investor can always say, okay, why don't we just buy the long-term U.S. Treasury? Yes, you can also buy the long-term U.S. Treasury to capture these rebounds. But in addition to this interest rate sensitivity, the S rates also has its own growth component, such as the dividend yield, such as the AEI, and such as the requirement overseas acquisition of the global properties. So they can both benefit both from this rate cut cycle and also the growth recovery cycle. So that's a very important differentiation versus pure bond positioning for now. Seems there's one more. Let me check. This is okay. What is the dividend payment frequency? Yeah, the dividend payment frequency is semi-annual. Typically, it will be announced January and July, and will be paid in February and August. So, for example, our most recent dividend yield is announced in July and paid in August, and the annualized dividend yield is roughly 6.2%. But since we already paid this dividend, but the investor shouldn't have too much concern, because now we think the next couple of months, the major contribution from these holding this ETF will not be the dividend, although we will still pay the dividend on a half-year basis. But the most potential for these SRT, the ETF, will be the capital gain, because of the upcoming Fed cut cycle.
So there's another question. I think with the decrease in the US rates, will this impact dividend yield?
I saw this one. As I mentioned, it really depends. If you think, if you solely from a market movement perspective, let's say the impending decrease in US rates, if they finally translate into a higher price of the underlying S rates, and if the dividend is more, if the DPU is more stable, then it may imply a lower dividend yield of S rates. But just as I mentioned, if the interest rate is getting lower, it means the funding costs for the underlying S rates are also lower. So they can have a more potential to expand their yield spread advantage in the near future. So from this perspective, you may see an even higher dividend yield, even together with the higher price. So that's why we think this is the key differentiator between the S rates and the US Treasury bonds. Because if you talk about the US Treasury bonds, you may see the high decrease in US rates together with a higher rates and together with a lower yield, which is quite natural. Because they don't have a growth component. But for S rates, since they have a growth component, this means the dividend yield can be higher together with the higher price in the future. So is the DPU fixed, meaning SRT price increase fixed yields result in lower yield? I think this question is very similar. Again, DPU, when I mentioned the DPU, I'm talking about the underlying S3's DPU. So this DPU is not fixed. It really depends on their business, how well they can do their business. So for example, recently or in the previous quarters, the DPU is even lower from these because of these cost pressure. But at ETF level for the SRT, these our dividend yield, we have a very strict rule, which means that we will every 6 months, we will distribute all of our underlying dividend yield we received from our underlying S-REIT holdings, and we will compare these versus the index, the benchmark yield we are tracking. And if our portfolio yield is higher than the benchmark yield, we will pay our portfolio yield. But if the benchmark yield is higher than our portfolio yield, we will still stick to the benchmark yield, which means we will pay the yield whichever is higher. So from this perspective, these dividend yield will be highly likely to be stable. And again, if the SRT price increased, as long as the underlying holdings DPU, they can be improved. It doesn't mean that the dividend yield will be necessarily lower. It can still be decent, let's say close to 6% level. Can you help me understand what is unit creation redemption and what condition would be triggered? Yeah, I think you also raised a very, very good question. And typically for individual investor, when you buy or sell on the Philip platform, it means the trading on exchange. But these doesn't mean that does not necessarily trigger a creation or redemption. I think there are two scenarios which could trigger the creation or redemption like a mutual fund in primary market. For example, if there is a strong buy demand on exchange or through the Philip platform, the Philip find they don't have enough inventory, they may create new shares with us and with a very competitive price, and then add their inventory and to sell more to the exchange investors. And also this is also same to the redemption as well, if they see much less demand and more sell demand. But another scenario is that for those large institutional investors, if they don't think the exchange liquidity is enough to absorb their buy or sell demand, they can directly work with Philip or with other brokers to create shares or redeem shares using a market on close price. And this starts from 50,000 units. It's also quite straightforward. So we can handle both ways of the buy and sell, such as on exchange buy and sell, and also these primary creation and redemption, and both can be done through the Philip platforms. Yeah. And moving forward, which do you think will perform better, SRT or SRU while be capital gain yield? I think this is also quite good question, because in the past, because of these very aggressive rate hike cycles, SRT and SRU will not always move in the same direction because SGD may not always follow the US dollar movement. They used to be strong for a while, but in recent year to date, they tend to be weakened a bit. If the Fed finally start to its rate cut cycle and DXY or the US dollar start to weaken a bit, I think the natural change for SGD is maybe a little bit stronger SGD, at least in the short term. So from that perspective, maybe SRT may outperform SRU for a while, but in the middle to long term, if the MAS will also follow an easing path similar to the Fed, then we may see the Sing dollar will weaken again or correct back to the weakened side again versus the US dollar. And if that finally happens, then we still believe we can use more for the US dollar asset class. Yeah, hopefully it's can clarify your question, because simply speaking, if you use SRU and your underlying currencies are stronger, for some not necessarily SGD, they can be other underlying currencies, then you should see an even stronger SRU performance. Then otherwise you should use SRT to forget about the SRU as a class. I think at least for local investors, for the Singapore local investors with your currencies is in SGD, I think it's more straightforward to directly use SRT.
All right, so we'll just take one more question if there's any. If not, We'll just wait for the next 3 minutes. If no more questions, thank you for joining us this afternoon. Okay, if there's no further questions, once again, thank you, Phillip Securities, for hosting this, and thanks, Bruce, for sharing your insights with the clients. If you have any questions, just feel free to drop Marine Parade branch an email, and they will get in touch with you. All right, thank you.
Thank you, everyone. Enjoy your lunch.